In today's episode, I will be discussing interest rates and property prices. It's an interesting topic because interest rates are probably the number one thing that people think about when it comes to property prices, but I've broken it up into four key sections. Number one, what effect do interest rates have on property prices? Number two, where are we at on the interest rate cycle? Number three, why interest rates should have little impact on your purchasing? And number four, what will happen to property prices with present interest rates? Let's get into it. The effect of interest rates on property prices. I've broken it up into a few key points. First of all, the cash rate. Secondly, the comparison to the US. Third, the effect on different cities in Australia. Fourth, the sub $3 million market and its effect. And then fifth, suburbs where cash purchases are fairly common. Let's start with the cash rate. Now, a lot of people don't know what the cash rate actually is, so let's just get its definition out for everyone to know. So the cash rate is the interest rate that banks borrow funds from other banks in the money market overnight. So basically what this is, it's the overnight borrowing for banks, the rate that they actually borrow at. So that obviously influences the home loan rates and the fixed loan rates for everyone. Not only that, but also business, commercial lending and everything like that as well. So it has a large effect on what we're talking about today. So in comparison to the United States, look, a lot of people, and I've got a lot of comments recently from people from the US, Europe, and other parts of the world, and they don't actually completely understand the Australian market. Now, in especially the US, all loans are basically bought on a 30-year fixed rate. So what happens is the actual market that is relevant to the high rates is only who's borrowing since the rates have gone up. Because people that bought in 2021 had those ultra low rates locked in for 30 years in the US. So that's the reason why they are a lot less affected than Australia. Whereas Australia, as you can see in the graph here, now this is from APRA, major banks and the RBA as a source, you can see that the vast majority of our lending is actually not fixed and it's actually variable. So at the moment, you'll see here, most fixed rates, especially if you look towards the end of 2023 there, have actually expired. So it's over 80% of our rates now are actually variable. So that's the reason Australia doesn't need to raise rates quite as much as the US, because we are much more volatile to rates than the US, because our lending is mostly variable and you can only get a max interest only period of 5 years as well. So, and also your fixed rates, you can only do 5 years too. You can't do 30 here. So that's another reason why we're a lot worse affected. So for those people, and look, I thank you for obviously watching my episodes from the US. That's just a bit about the Australian housing market. We're not a fixed rate market. We're primarily variable. Let's get into interest rates and house prices. So you can clearly see here, this is just since the early 2000s with the cash rate target and basically property price growth. So you can clearly see here it does have a little bit of an effect, especially if there's a large increase on house prices. But the key thing here to just note is that this is largely affected by Sydney and Melbourne. Sydney and Melbourne make up about 60% of the market, actually a little bit more to be honest. Who are actually the most volatile to interest rates. And you'll see that in basically the next few slides that I will go through. So Sydney and Melbourne here, you can clearly see basically you've got the 2002 to 2008 sort of period where it was very quiet. And then you can also, as of recency in graphs, you will see that also Sydney and Melbourne have been fairly quiet compared to Brisbane, Perth, and Adelaide. Now, if I go to another graph between 2002 and 2010, you'll notice that when basically rates were fairly high, that Brisbane actually went up quite a lot. So it's fairly different to Sydney and Melbourne. It's not correlated. It's kind of against what Sydney and Melbourne do, usually Brisbane and Perth. So usually when Brisbane and Perth are going along very strongly, Sydney and Melbourne are actually quite quiet. And on the contrary, when Sydney and Melbourne are quite busy, often Brisbane and Perth are actually quite quiet. So it's actually good news because you can kind of buy one and then jump straight into another and still make a good sum of money. So just keep that in mind, but that's basically your effects on prices. Sydney and Melbourne definitely are more volatile to interest rates than Brisbane and Perth, and especially your other markets that primarily are a lot cheaper, especially for their median income. So that's why, despite interest rates going up quite a lot, Perth still grew recently, because despite interest rates going up, the actual income that was earned there was, very sufficient to continue it going up, and it still is now, despite obviously prices growing somewhere between 30 and 60% depending on the suburb you're in. There's a key part that people don't know in the market, and it's the sub $3 million effect. So you'll see this is a 2022 graph, cash sales, and this is in Sydney. So primarily the market that's actually affected by lending going up, or should I say interest rates going up, it's actually not suburbs that are over $3 million. A lot of them are actually bought in cash. So you'll notice here, and for Sydney siders you'll know this, Mossman, Darling Point, St Leonard's, Vaucluse, Manly, Bowral, Cronulla, Bondi, Bellevue Hill, Kellyville, and Randwick. That's around half of the suburbs just in this alone, and they are all well above $3 million if you're looking at houses. And the people that are actually paying cash are often the house buyers. They're not the unit buyers in these suburbs. So Bellevue Hill, you'll see 3.9 million in 2022. You can still get units in Bellevue Hill for around 900 to 1.2 million, but most of those cash purchases are actually people that are buying houses, because not many people actually get loans above $2.5 million. It's quite rare. It's mostly people getting small loans for very expensive houses, or just buying them outright in cash. So what people don't understand is, and can't sort of, realize, is that the Sydney market that's especially very expensive. So you'll notice Bellevue Hill now is above $10 million. And the reason for that is it's not an actual lending market. It's a market where a lot of people actually buying cash, which sounds insane, but it's actually true. So that's the reason those suburbs continue to go up despite interest rates, because they're not actually affected by interest rates that much, especially the top end of their market. So you've got billionaires buying in these suburbs, and a billionaire is $1,000 million. So, paying $6 million or $7 million isn't really that much in terms of their net wealth. So that's why they continue to go up. Look, here's another graph, or should I say table, just of cash purchase of suburbs for Melbourne. And you'll see again here, Carlton, Brighton, Chirac, Malvern, they're all very rich suburbs. And you've got also the presence of your Mornington suburbs. So Mornington, Safety, Beach, Rosebud, Mount Martha, they're all, I guess you could count Hastings as well. That's kind of Westport, but still you could still say that's on the peninsula. Those are all mostly people either downsizing, retiring, or just moving for a quieter life. It's become really common since COVID, especially with working from home. So that's the reason you'll see these cash purchases. In Melbourne CBD as well, mostly those cash purchases are actually the apartment buyers who are buying literally those huge apartment blocks in the middle of the CBD. Quite a lot of Chinese and Asian buyers are actually there. But to give you an idea, again, these aren't cheap suburbs. It's not as if we're saying this is Point Cook, this is Truganina, Tarneit, Officer, or somewhere like that. These are suburbs with mostly above $1 million median prices. Some of these above $2 million. So again, the expensive markets generally aren't affected as much by interest rates, simply because a lot of people own their houses outright, and you have very wealthy people buying in there. So just keep that in mind when looking at properties and interest rates and suburbs, because if you're buying a suburb that's, let's say, $1.5 million or $1 million flat, that will be affected by interest rates. But if you're, let's say, very wealthy and you're buying something that's $10 million in Bellevue Hill, or $6 million in Chirac, or maybe, let's say, $4.5 million in New Farm, you're probably not as affected by interest rates there in terms of suburb prices, because people generally don't in these suburbs buy in with large lending. They mostly actually buy in cash. So anyway, that's dispelling that myth, I guess. A key part of this as well is the mortgage belt. Now, what is the mortgage belt? Look, it's basically suburbs where there's a high concentration of owners that are mortgaging their homes. So look, the areas generally that this is your new estates. So I know, look, a good example of a mortgage belt suburb would be somewhere like Jindalee in northern Perth, right up towards the far northern coastal region of Perth. Now, these areas are mostly, almost entirely first home buyers or unknowing investors. So most of them are leveraged at 80% LVRs or above. So what that does is it makes it extremely volatile to interest rates because these suburbs are very highly leveraged. Now, you don't get the same thing in inner suburbs where you've got an average LVR of 50, 40, or let's say 50% of people owning their homes outright, because the reason for that is they don't need to sell if interest rates go up because they own their home outright. It doesn't make a single bit of difference whether interest rates go up or not. So look, a rule of thumb is absolutely avoid mortgage belt suburbs at all costs. Just avoid them. If someone tries to make you buy in a new estate, just tell them to piss off. It's just a bad idea, and they're probably trying to make a buck off a developer in sort of a backdoor deal. So don't buy there. Look, a few examples of these are just regions of sort of areas where you've got, high mortgage belt, or should I say high for sale. So that's mostly in mortgage belt suburbs. So Blacktown North, that's towards Schofields. Melton, Bacchus Marsh, that's a lot of new estates out there. And Casey South is also a lot of new estates in should I say, the very far out of Melbourne East. So look, don't buy any of those areas. Just a word of thumb. If you want actual suburbs that are bad performing in terms of loan arrears, here's some for you. You've got, I'll just read ones out so you can see the clear distinction with all of them. You've got Broadmeadows there, Bonnyrigg, Katoomba, Dolls Point, South Melbourne, Forestfield, Barclay, Blackstall, Smithfield and Addington. So a lot of these suburbs are in either very, should I say, poor estates or close to new estates. Some, especially South Melbourne, and the reason it's listed, it's actually not because of houses. Houses are actually a very good buy in South Melbourne because they're so hot in demand from developers because of the zoning and the proximity to the CBD. But it's actually the apartments. So the reason this is coming up, and it's the same as Dolls Point, is because a lot of the apartments in these areas are just new home buyers that are leveraged to the hill. So just avoid them at all costs. Very easy rule of thumb. And just don't buy there. It's as simple as that. Where are we at on the interest rate cycle? There's a few key points here I'd like to make. The history of interest rates, the capitalisation of interest rate payments and HomeKeeper. That's a really interesting one. Where are we at on the interest rate cycle? What is keeping interest rates high? And what my predictions are for interest rates. Let's get into it. So look, a little bit of the history of the RBA. If you look here to the early 90s, we actually had the cash rate above and towards 14%, which was incredibly high. A lot of people, from older people that follow my channel would say interest rates are just low, which I do agree with, but it's all obviously relative to what prices are. In the 90s, you had, especially early 90s, houses selling for literally under 100,000 within 10Ks from many CBDs, and even in good Sydney suburbs under 200,000. So, let's just be real there. But anyway, you can see here clearly come down after the recession. During the recession we had to have in the 90s, then it was basically pretty stable to around the GFC, obviously up and down a bit. It fell after the GFC, then went up a little bit to about 2011, then it came right down the whole way basically to COVID, and then came back up in recency. So that's a bit of the history of the cash rate. Generally speaking though, it comes down when things are going wrong, so just keep that in mind. Look, something that's come up that is really interesting with interest rates and financial hardship is a lot of banks now are actually letting you capitalize interest payments. So this is just something out of the banking code of practice. What banks are doing in times of financial hardship now is they're actually allowing interest-only payments, sometimes extending the term of loan repayments, which reduces your monthly repayment or weekly or whatever, however you pay it, or otherwise they'll postpone your payments and you'll just capitalize the interest in total, which you obviously then pay a larger principal and interest payment in the long term. So that's what they'll do. But the issue with this I have is that what it's doing is it's actually artificially propping up the market and actually making, the market look better than it is in some circumstances. So all this is going to do is make turnover of stock and property less. This didn't used to happen in the the banks genuinely used to take people's homes and sell them. Now, not that I'm insinuating that that's an awesome thing to do. It's very bad. But if you want the market to actually work itself out and be where it is, it's something that does have to happen. But with them capitalizing interest payments, this is going to continue to happen, and it's actually going to be, quite bad in the future if they continue this. But anyway, that's what they're looking to do. Something that's recently been talked about is something called HomeKeeper. I first of all thought this was a joke, and I actually told a few of my friends about this last year, and they nearly fell off their seat when I told them it. But basically what it is, it's similar to JobKeeper, but it's actually for people to keep their homes. So the government has been talking about something recently in saying that if people were falling behind on their mortgage repayments, what they would do is they take a small equity stake in their property, and then therefore people can stay in their homes. Now, for a lot of people that believe in obviously all of that World Economic Forum things, you'd obviously go straight to the quote, "You own nothing and be happy," and it's just unbelievable. This should not be a policy, but it's something that they definitely have looked at. So this is just an article literally out of a news bulletin recently. You can find that online. It's publicly available information, but that's something else that they've been looking at, and it's going to create more shortages of stock. So it's something that they probably shouldn't do, but it's something that's also been talked about. Interest rates and where we're at. So look, just speaking, and people just need to know this, interest rates generally fall when there are a few key things. Number one, there's weak economic activity. Number two, the cash rate target is achieved comfortably. Now, what I mean by comfortably, I don't mean that it's hit it for 1 month. I mean it's been there for 3 to 6 months. It's generally when they look at it. And the other one is the international economy is weakening significantly. So those are the key things that I think everyone should consider when they do their interest rate predictions, because at the moment the economy is, I'd say, fairly strong. It is weakening in some elements, but it is definitely fairly strong in some ways. So a lot of people, I think, are quite, quick to make their assumptions and just reactive. But let's look at really what happens here. So where we're at, in my view, is now I've actually just drawn up a cash rate kind of circle around where I, in my view, think we're at in the interest rate cycle. So you can see here between us about 2016 and 2020, what kind of happened was the cash rate did go down a little bit, but then it stabilized for quite a long period. And I actually think this is what's going to happen in the future as well. And I'll tell you the reason why. The reason for this is because what we're seeing at the moment is we do have a few things in the economy that are weakening. So obviously, definitely the unemployment rate is rising. It will continue to rise, no doubt. Look, a lot of that's due to very poor policy, but I'm not going to get into that anyway. But that's one thing. And the other thing is consumer and business confidence is also very low. So because of that, what I think you'll see is they will probably pull the interest rate down a little bit, then it'll just stabilize for a long period. And then when we have the next, crisis or next major financial event, that's when it will actually really come down quite significantly. You can see that's fairly consistent along a lot of, I'd say, recent years and recent decades, probably aside from your dot-com bubble and GFC, but other than that, it generally does come down a little bit and stabilize for a little bit before they really tend to drop it. So I think that's what's coming. So from that, what are my interest rate predictions? Now, look, I said, and I'm someone who likes to stick to their guns until proven wrong. So I actually said to a lot of people, this was late last year from about, I'd say, September, October. I'm still of the belief that we're getting one rate cut this year, and that'll be 0.25%. Look, I simply think that because you're going to have a lot of international pressure, one, and number two, not only that, you're also going to have a lot of pressure in terms of the unemployment rate and just consumer confidence in general, because the RBA will know that if we have a bad Christmas, particularly this year, they're going to have to drop rates further. So I think what they'll do is in their final November meeting, what they'll do is they'll say, okay, let's cut it once and just see what happens. And that's my prediction basically for this year. Then I think in 2025, we will get 3 rate cuts, in my opinion. If we don't get that rate cut in November of the year, we will get 4 in the year, but that's an absolute total, I'd say, in 2025. So it'll be from now to the end of 2025, whether it's 1 this year, and 3 next year, or just 4 in 2025. That's, I think, what we're going to get. But then after that, I think, as I said previously, you'll see the cash rate stabilize for quite a while. And when I say quite a while, I actually think it'll be at least 12 months, maybe longer, before we actually get, I'd say, a fair cut that will go back down towards that very low interest rate that we had. And unfortunately, they shouldn't do that, but that's what they do because they just continue printing money when anything's wrong. So that's what my interest rate predictions are and what I think will happen. Why interest rates shouldn't influence your purchasing. This is a key part because I think a lot of people just simply think I should buy because interest rates are low, or I should buy here because, interest rates are high, all that kind of stuff. Now, look, that's just ridiculous. Look, if you're buying a property, and let's say, first of all, if it's an owner occupier, you're buying there to live, so for good facilities, good place for your kids to live. If you're retired or older, you might be buying it because it's close to the beach or near something you really like. If you're an investor, it's only the numbers that matter. So those are just ridiculous reasons to buy. 3 key points I just want to make here. The historical growth rates, dollar cost averaging, and property being a long-term asset. Look, historically, property's grown incredibly well. So this is just an extract out of the Aussie Home Loans 25-year report. And the reason I use this is because I want to use something that's publicly available for everyone. So you can see here, if you just look at the historical growth rates, you can clearly see Sydney and Melbourne outdoing basically everywhere else. I'll just say as well, Brisbane looks bad there, but if you look at the inner suburbs of Brisbane, it's very good, and also some suburbs of Perth are good too. Geelong, Wollongong, Newcastle, also very good. Some parts of the Gold Coast and Sunshine Coast too. But look, you're not buying, as you could see that I've previously said, interest rates go up, they come down. That'll happen over, years, decades. That'll continually happen. But the real thing you're looking for is good capital growth and good rental growth. And again, capital growth also goes with rental growth in most circumstances in the best suburbs, because rental growth, or should I say yield, is a representation of your asset value. So that's your most important thing when looking at houses. Don't just look at interest rates. It's just a ridiculous strategy. Dollar cost averaging is something that everyone should know and should consider. What dollar cost averaging really is in simple terms, it's value investing. And what that basically means is it's a fixed amount, or should I say, per interval that's invested over an extended period. Now, the easiest way to think of this in property really is, there's a couple of points I just want to make. And if you do this correctly in property, you'll do very well. First of all, buy whenever you can and what you can afford to. So obviously whenever you can, and what I mean by that is in point number 2, laws, lending, opportunities change, fundamentals do not. So if you can afford to, and you're in a life situation to, just buy a property in the right area. You're going to do very well out of it. Now, I don't mean if you're, for example, you're about to have a kid and you're going from a 2-income household to a 1, and expenses are going to go up as well. That's not what I'm saying. I'm saying if you're in a situation, let's say, where for the next 2 years, you've got either a fixed lease, you might be living at home, you might already own your home outright, for example, so situation's not going to change and you can afford to, and lending permits you to, you should just do it. That's what you should do. Now, third reason I got here is principal is paid down with yesterday's dollars at tomorrow's prices. Now, everyone knows that with inflation, things tomorrow just get more expensive. So that would mean things yesterday are a lot cheaper than what they are tomorrow. So if you're buying something, you're effectively paying in the future yesterday's dollars, but with tomorrow's salaries, with tomorrow's income levels, with tomorrow's interest rates. So, and generally over the long term also, interest rates do come down because they've just continually done that to erode away debt. So that's going to happen in the future again. So that's another thing. Now, I've done a video on this in the past. So for new viewers of this, just search up on my channel, time in the market is more important than timing the market. So all I mean by that is literally just look at a video I did on that, search that up exactly. I did it on Newcastle and Logan Central in in the after the GFC. So I did something where you could see one market come down a lot more, and it looked like it was you got bargains, and the other didn't come down as much. But I just proved that you'd make hundreds and hundreds of thousands more, even that was only at a $300,000 price, just from buying correctly, rather than just trying to time the market and get the cheapest deal you can. So just consider that when buying property too. Now, property is a long-term game. Look, for people that are on a retirement plan, it probably isn't a long-term game for you. So you can take this with a grain of salt. But for the absolute majority of people that aren't wanting to retire in 2 to 5 years, property really is a long-term game. You need to consider areas that have performed well over a long period when buying. So I've actually got this news article here, and it's incredible. There was a Paddington Terrace, and this was in late 22. So it was actually at a period where the city market actually came down quite a bit. Sells for £2.275 million after being bought for £1,150 in the 1950s. So if you actually put that in a graph, it's literally growth like of above 8% for literally more than 70 years in Paddington. So for those who want to know an area that does perform well long-term, Paddington is definitely one in Sydney. Actually, the Paddington in Brisbane as well is also a very good suburb. So, in this article, it is Paddington in Sydney they're talking about. But just think of it as a long-term game. Look, you'll get areas that do well over 2 years and go to sleep for 15, like all your idiot buyers agents at the moment are saying to buy in Townsville. Just don't buy there. It's going to do well for 2 years and go to sleep again. You get good cash flow, but you also pay a ton of levies in council rates, a ton of insurance rates that are 2,000 more than almost anywhere else in Australia. You'd pay, particularly your metro non-flooding markets. So just don't buy there. It's just rubbish. That's one. Another thing I've just got here is an actual suburb where I can explain to you why you buy property as a long-term asset. So this is in Yarraville here. So in the 90s, believe it or not, Yarraville had a premier called Jeff Kennett. Now, Kennett, by a lot of Victorian standards that have been there, is known as probably, I don't know whether the new people think that Dan Andrews is worse than him, but that's probably up for debate. But Kennett was known as a very poor premier for Victoria amongst a lot of Victorians. Now, despite that, Yarraville you could have bought in the 90s for between 120 and 150 grand quite comfortably. Now, today, post the dot-com bubble, the recession we had to have, the GFC, and COVID-19, you can see between 2021 and 2023, so it's basically today, prices have literally gone up tenfold. So don't think of property as a short-term game. If you're buying, and everyone in my view should buy with the consideration to hold it forever, but if not minimum 10 years, look at what the prices have done long-term, or otherwise that if it's gentrifying quite significantly. But you need to be buying in areas where it goes up for long-term, not Townsville again. Don't buy somewhere like that everyone's pushing. It's a rubbish area. I've done a previous video. Have a look at it. I compared, I think it was Townsville to Footscray, and that's right next to Yarraville. They were actually the same price in the 1990s, the early 90s. Actually, you could probably even argue in the late 80s, early 90s that a place in Townsville called Heatley was actually more expensive than it. Now it's what, 400 to 450,000? And Footscray is nearly $1 million. So, just don't believe that rhetoric. Buy quality. Don't worry too much about timing the market. Buy quality always. That's what you need to do. Now to everyone's favorite part, what I think will happen with property prices. I've divided this into a couple of key segments. Now, the reason I've done this is simply because I truly believe that property is a long-term game, as previously discussed. So I've done the next 1 to 2 years, what will happen, Warren Buffett's value investing philosophy, and then the next 5 to 10 years, which in my view is actually the most important. Let's get into it. Look, the next 1 to 2 years definitely will be shaped by three things. So one thing is higher interest rates. Number 2 is lower supply levels. And number 3 is lower affordability levels. Now, again, I've previously discussed interest rates are here to stay fairly high. There'll probably be a couple of cuts, but they'll still be fairly high for obviously our pricing levels that they are now. Supply is just going to get worse. We're bringing in hundreds and hundreds of thousands of migrants every single year. And that includes students as well, which are temporary migrants, which only make, especially in the cities close to universities and amenities, even worse. And we've got a building exodus, builders going bust all the time, not enough being built, so that's just going to get worse and worse. I hate to say it, but it's true. And affordability is, I think, almost at an all-time low in a lot of places, so that's just going to continue. Now, due to this, I'm telling you right now, the best performers will undoubtedly, in my view, it'll be Brisbane and Perth by a country mile. Now, you can probably add Adelaide to it, but Adelaide's not an area I generally look to buy in, just simply because historically, and I'm telling you, into the future, long term, it will not perform as well. But Brisbane and Perth do have some very good performing suburbs long term, particularly Brisbane near the CBD, and particularly in some Perth regions. So they're very good areas to consider when looking to buy, especially if you're considering the next 1 to 2 years. So if you're on your retirement plan, that's the areas I'd look to buy. Or otherwise, look, even if you're not on your retirement plan and you just simply want to get into the market and that's the price point you have, because they're obviously quite a bit cheaper than Sydney and Melbourne, these are areas to consider, especially for the next 1 to 2 years if you can afford to and you have a lower budget. Look, a key part of, I think, investing in general, and this is stocks, property, business, everything like that, is value investing. Now, Warren Buffett is obviously the most successful investor of all time. He's obviously been scrutinized tons of times and, throughout decades and decades of him investing. But then again, Berkshire Hathaway, an investor who bought there like 50 years ago would be worth like $1 billion if they invested only like $1,000 or something like that. It's just insane. So I think he's a good guy to listen to. And one of my favorite quotes from him is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Now, everyone should think of property the same way, because you don't want to just buy something that's cheap, that's bad performing. Most bad performing assets are cheap, and they're cheap because they're bad performing. It's very simple. But most of your best suburbs are fairly expensive, but the reason they're expensive is because they perform very well. You don't have cheap and high performing. It doesn't work. The only time that can ever happen is when it's going through gentrification, number one, or number two, the price point started at a significantly lower amount than another area. So the only two areas I can really think of that happening is Geelong and Newcastle. That's the only two areas I can really think of that happening that have performed long term in Australia. So just consider those areas when thinking of this. But look, really importantly, in my view, is considering property in the next 5 to 10 years, because it's the minimum time, in my view, that you should be looking to buy property unless you're on your retirement plan. So what really is going to shape property in the next 5 to 10 years? There's a few key things here. Number one, demographics. Number two, business demand. Number three, international demand. Number four, shortage of supply. Number five, that combines with excess demand from a wealthy demographic. And number six is your lifestyle triangle. You could probably add in Sydney and Melbourne exclusive school zones to that as well, but these are the main things, because the exclusive school zones are basically where all of these things are anyway. So demographics in general drive property markets. The wealthier people are in a suburb, generally the wealthier the suburb is in terms of property prices, and also the more people can do with their property if they want to do renos or anything like that too. Business demand and international demand are really key. We are a country of immigrants. Most people in Australia are from an immigrant background or a second or third generation immigrant. So that brings, a lot of porters to the southern hemisphere of companies. So that's the reason you have a lot of, money coming in these markets. Shortage of supply is another one. So, your inner suburbs in a lot of these areas and your best performing areas, generally there's just no supply consistently. That's why they grow so much, combined with a wealthy income demographic. Lifestyle triangle, again, if you're close to school, work, and lifestyle facilities, people pay a premium for it, so just consider that too. Upon all of this, look, the next 5 to 10 years, I'm going against nearly every person you will see in basically the country, in the fact that I'm actually predicting that in the next 5 to 10 years, especially, I'm more talking especially towards the 10, our top performer is going to be Melbourne, and I think it's going to be comfortably our top performer. Melbourne is actually the best performing city in all of Australia. Though people tend to forget that because for the last 6 to 7 years, it actually has been fairly quiet, aside from probably your Mornington and probably your Bellarine Peninsula, particularly towards like Barwon Heads, Anglesea, those sorts of suburbs. And I'd probably say as well your Portseas and all those sorts of suburbs too in Mornington. But look, there's a saying, and I'll go back to probably one of my favourite sayings as well from Warren Buffett, and he says, be greedy when others are fearful, be fearful when others are greedy. So, look, everyone's fearful of Melbourne and also some parts of Sydney, and I've got that as your number 2. But Melbourne, by a country mile, your top performer. And it's simply because everyone's fearful of that, but there's actually some really good deals in Melbourne, and there's some of the best performing suburbs. Some suburbs have performed at above 9.8% for more than 30 years here, and you're picking them up under $1 million. So I'm telling you, in 10 years, they're going to be worth more than $2 million, 100%. And, if they're not, I'll buy it off you for whatever price you pay for it today. So please contact me and I'll buy it off you if they're not that price, because there's a straight offer from you, because if you're buying in the Melbourne suburbs that I know are very good performing, just look at your Aussie Home Loans 25-year report to find them. If it's cheaper than it is today in 10 years, please call me and I'll buy it off you, because I'm telling you that's going to be easily your best performing suburb, especially in your 5 to 10 year, towards your 10-year mark in Australia in the future. Anyway, we're coming to the end of the episode, but I'm actually going to tell everyone where my videos are going in the next few weeks. I'm actually going to discuss in the main cities that I buy in. So these are especially your Sydney, Melbourne, Brisbane and Perth, what your cheap suburbs are in different council regions or different city regions there. So stick around for those episodes because they will be really worthwhile. And I'm actually giving people basically free knowledge of where to buy, why you'd buy there and that kind of thing. So stick around for those episodes. Thanks so much for watching. Please subscribe to the channel. And if you're looking for a buyer's agent in Australia's best performing suburbs, be sure to reach out via www.compoundinvest.com.au. Thanks again and welcome to the channel. I'll see you on the next one.